I want to thank you for joining me today. In this webinar, I'm going to talk a little bit about the markets and what's been going on, as well as some things to keep in mind in these type of markets. I know that it's recovered a lot, but it's certainly been a turbulent market to say the least, and I'll share a little bit of data later on that kind of talks about that too. So the first question whenever something like this happens that we often ask is, how long is it going to last? We don't really know. I mean, I know it's really hard to forecast. We don't have any certainty about what's going to happen, when it's going to end. I mean, it's the same thing with the quarantine and the virus and all that. We don't know. There's a lot of uncertainty. And as a financial advisor, I really care about my clients. And this is one of my greatest concerns, because I don't want to see my people be worried or afraid about what's going on. I want them to make sure that they know that we're in this together. So this is just to give you some perspective. This is a chart from First Trust. It shows that on average, when we have a bear market, it lasts 14 months in the period since World War II. Market corrections, on the other hand, have only been lasts about 5 months long. And so to give that context, a market correction is deemed to be a 10% or more decline. It doesn't hit a bear market till we get to 20. And so right now, at the worst of this market, we were down about 34%. Now we've recovered more than half of that. So one of the really important things to remember is that your long-term goals haven't changed. You want to keep your eyes on the goal. You shouldn't change your goals today because what the market did. The market's always going to change. It's going to go up and down. It's important to remember what you're thinking about for the long term. And so, like, if you look at this image, I thought it really exemplified that pretty well. Because when we see that, we think of a track. And a track is usually a short race. But if you see, this is a track that goes way, way out into the distance, further than our eyes can see. When I work with clients, I have a roadmap that I put in place, because one of the things to help manage things like this better is to be able to be prepared for it. So if you look here, there's a 9-step process that I go through when I work with a client putting together a financial plan. And one of the most important parts for situations like this is, if you see on the build level over at the right, there's a box for risk tolerance. What level of risk am I willing to accept? So there might be a bump right now, but we want to make sure that our roadmap still helps us get from point A, which is really being uncertain about what the future might look like and what retirement might look like, to point B, where we're much more informed about what retirement might be like. So now I'm going to share 14 things that I've learned about, like I said, the markets and how to deal with things like this that I think are worth sharing. I've given this webinar a couple times, and the market condition have changed some since the last time I gave it. So I've changed the slides a little bit to reflect the changes in the market as well. So one of the most important things to remember is we should try to do our best to stay safe and healthy, because we're not just, for most of us, not all of us, we're not just taking care of ourselves. We have family, we have clients, we have other people to take care of beyond just ourselves. It's also important to remember that the stock market doesn't move in a straight line. We have a bear market about every 6.25 years. The last time we had one, it was 12 years ago, so we were probably overdue for a bear market. Every time we've had a bear market, it's always come back. The only instance I can think of, or that I know of, where a market hasn't come back is in Japan, where that market peaked in the 1980s, and it's never really returned to the highs that it hit then. So it's just a reminder to remain focused on the long term, not the short. Having a plan in place can help you feel prepared. We've had companies that have declined, and some that are still down 30 or more percent, even though the market's only down about 10% year to date. And the high that was reached, it was in mid-February. But that doesn't necessarily mean that those companies are worth that much less. The market is hard to forecast. Prices of companies move every day, and honestly, the value of the companies don't change as much as the market reflects on it in many cases. This is a long-term performance chart of the S&P going back about 35 years. It just shows you that the market has its ups and downs, and you can see it's hard to see over on the right, but there is a line there where the market has, you can see that it's recovered more than half the losses. But when you're saving for retirement, you have to remember that one of the things that you're doing is you're expressing a belief that the market's going to move higher over the long term. So if you didn't believe that, then saving for retirement really doesn't make that much sense, and putting money into the market doesn't really make that much sense. So it's important to remember that not to let what happens now lead you to take actions that you'll regret later. So one of the hardest things that people often face is, like, they get scared and they say, well, I want to get out. The problem isn't getting out. The problem is once you get out, knowing when to get back in. And that's what's really hard. So if you go back to the last, we had a major market dislocation. It was 2008, 2009. Some people that got out during that time frame never got back in, and they missed a lot of gains by doing that. So one thing that I ask myself is, why isn't the market down more right now? Because if we look at it, the market's about to levels where it was a year ago, but our economy isn't as strong now as it was then. So why isn't it down more? Well, one of the things that you see is the 25 largest companies in the S&P 500, which is one of the most popular benchmarks that people use to measure how the market's doing. Those 25 companies, which are listed in the second item on this slide, represent nearly 40% of the total market. And if you look at that slide, you've got companies in there since this market decline started in mid-February. The market had peaked on the 19th of February. Amazon is up over 20%. Microsoft is up 12%. JP Morgan Chase, Bank of America, and ExxonMobil are all down more than 30% since that time, or about 30%, and Disney is down a little over 20%. So you have a lot of disparity, but overall that group, it's outperformed the market since the peak. You know, if you go to when the market hit its peak on February 19th, these 25 companies were up 3.7% collectively. The S&P 500 was up 4.8. But if we look at the period from February 19th to today, this group of stocks is only down 10%, and the S&P is down 13.2%. And what do these companies have in common? They're larger, they have strong balance sheets, and many of them are economically defensive. They have economically defensive business models. And so that there's been kind of a flight to quality, and that's what's led those companies to outperform, because those are companies that, if you think about it, are most likely to emerge stronger on the other side of this. And why is that? Because companies that have strong financial positions and strong capital, they'll have opportunities to take advantage of the weaker competitors. And so that's why those companies have outperformed. But there are pockets of the market that are still down a lot. So we have oil companies, banks, travel and leisure firms, recreation businesses, and small caps, because small caps are riskier and they generally need a stronger economy to do well. So if you need to access cash, remember that, you know, it's a good idea to have an emergency fund. Your safe money is your first line of defense. You know, if you have an asset allocation, use your non-stock investments to cover your short-term goals and reduce the volatility of your portfolio. Particularly if you're close to or in retirement, not all your money should be in the stock market. Some is set aside to protect you and help you avoid doing one of the worst things we can do as investors. And what's that? It's buying. We don't want to buy high and we don't want to sell low. So if you sell at the bottom, you know, that amount that you, that loss that you take, you can't recover it when you're not in the market. Before selling, ask, do I really think the return on this investment between now and the time I retire will be negative? If the answer is no, then it's probably not wise to sell. And again, it comes back to the question, if you sell, when do you get back in? So if you need emergency cash, this slide tells you the 10 sources of emergency cash ranked from best to worst. And you'll notice that number 7 is taking hardship withdrawals from your IRA or 401k. So when the Secure Act was passed, I'm sorry, not the Secure Act, when the CARES Act was passed, you know, they allowed you to take withdrawal from your 401k without penalty, and they give you the ability to pay it back. But that's really, while it's easier to access, you want to be careful about using it, because if you don't pay it back, it's jeopardizing your long term. So you want to be careful about accessing that money unless you need to. Look for other things first. And also remember that, you know, you should still be on track to achieve your most important goals, right? Even with the market being off, you're more than likely okay. You should be able to achieve those long-term goals. Perhaps there might be a little less money left for the kids if you're not working that much longer and you don't get a full recovery. But overall, we should still be all right from a long-term perspective. And also remember, this is not a good time to revisit your understanding of risk. If you're feeling over anxious, wait till we get to the other side to really look at your risk. Our concern is about financial security. What we need to do today to feel that sense of security, that's what we should do, but we want to be careful about doing too much. Don't want to adjust that asset allocation too much right now. So think about it. If we took it in a different context, if you had a beach house, you invested in it, you enjoyed it, and then a hurricane happened, and now the house is underwater. That's not the time that you're going to sell that house. You might consider selling it once you've made the necessary repairs, it's dried out, it's back in good shape. That's the time to decide if you really want to own that beach house or not. It should be similar with the stocks. Don't let fear and your emotions overwhelm you and have you get out at the absolute worst time. And this chart is really meant to show you the advantage of the diversification. Historically, it helps keep your portfolio from declining over long time periods. So if you look at this chart, a 50-50 portfolio means 50% stocks, 50% cash and fixed income or bonds. 75-25 is 75% in stocks and 25% in cash and fixed income. And then 100% stocks obviously is all stocks. And so you can look and see that over 5 years, the best annual return, well, the more stocks you have, the higher the return is on a positive side, but also it gets more negative on the other side. But if you look out over 10 years, you can see that over 10 years, we haven't had a period where your total return was less than zero, right? The worst annual return was 1.1% for that 50-50 portfolio. And a 75-25 portfolio was minus 1.6. So if you diversify and you can hold for a long period, that gives your portfolio the ability to come back. Also remember that a falling market can be your friend. If you're working and putting money into your 401k or some retirement plan on a regular basis, you should keep adding. You can average down your cost basis that way. Think about it this way. If you were adding $500 per paycheck, when the fund that you were buying was at $50 a share, you're buying 10 shares. That same fund falls to $40 a share. Now you're buying 12 and a half shares. When it gets back to 50, the shares purchased at $40 are now worth $625. The ones that you purchased at 50 are only back to even. So you got an advantage by purchasing, you got more shares for the same amount of money during that depressed market. And the other thing that approach does is what we see here. This is showing that if you added $100 to the S&P 500 each month starting in 2007, one of the nice things about that is at some point you see that the point here is the work that peak point, the peak decline, that peak gain is because that's what you bought at the bottom. So by adding money regularly, you are going to at least get some money put in at the bottom. So like I said, you want to rebalance with discipline, avoid acting with emotion, reacting with emotion. For my clients, I've been actively rebalancing. They have an allocation that they're supposed to have. When it gets a certain amount out of line with that allocation, I bring it back. So it's important to have a process and use that process to help make your decision. If you have a good process and you have a good outcome, your success is deserved. If you have a good process but a bad outcome, that's a tough break. But if you have a bad process and a good outcome, that's just dumb luck. And if you have a bad process and a bad outcome, you could argue that that's poetic justice. And the key too is that without having a process, it's hard to know when you've made good decisions or bad. Maybe over time you might have to refine your process, but you have to have that process in place, because if you just always are changing and doing things differently, it's really hard to know if what you're doing is the right thing or the wrong thing. It's also important to remember to be on the lookout for new opportunities. So in addition to my background as a chartered financial analyst, I'm also a CPA. I have a lot of experience doing taxes. And it's important to remember that taxes and investing are joined at the hip. So I always think about it, if we can do things to lower your tax bill, whether that be today or in the future, that gives you more money to spend either today or in the future. So, you want to think about ways to optimize your tax position when we have a falling market. And look at things like taking tax losses, which can be called tax loss harvesting if they're in taxable accounts. You can do things like Roth conversion. So if you have your money in an IRA or a 401k, you can convert it to a Roth. And there's a couple reasons that I think that that can be a really good strategy. And some of my clients, we've done that. One is because the government has provided record stimulus to help us get through this, a lot of money. There's a big cost. It seems unlikely to me that at some point in the future, we're not paying more in taxes than we are today. So when you have a Roth IRA or a Roth 401k, the difference is you pay tax on that money when it goes into the account, and it grows, then it grows free and comes out free. With a regular IRA or 401k, you don't pay tax on the money that goes in. It grows free, but then you pay taxes when it comes out. So you might be able to leverage your tax rates by doing a Roth conversion and taking advantage of those lower rates now, paying the tax today and then not paying when you pull the money out in the future. Also, you can consider if you have 529 accounts for your kids, maybe it's a good time if you're in position to do so to put the money in when the market's lower. If you have money, if you have a health care savings account, you want to think about, and you have the ability to invest that money, which you're allowed to do. Not everybody realizes that. You can invest. Another thing you can do is look at upgrading your portfolio. If you have stocks that you really aren't that good, that you're not that comfortable with, well, maybe it's time to look and replace them with better investments. It's also important to remember, if when we're investing, as I think I said earlier, we believe in the future. This isn't going to last forever. The strategy that we have works as long as we believe in prosperity. And I really like this quote: "The man who's timid and hesitating, who stops to listen to his fears, lets many a good opportunity pass beyond his reach." So it's important to not kind of get paralyzed by fear, and remember to keep moving forward and keep looking for opportunities and take advantage of them. Here we see some of the long-term returns of markets after the market bottom. So you can see, to also show you don't have to necessarily buy at the bottom. You can see in this chart, it shows what the peak market losses were, then what the returns were after 3 months. And the market was still down 3 months later, but 3 months out and 6 months out, it was much higher. And then this next chart will show you even a longer term. It'll show you 3 and 5 years out. You can see you get some really nice gains away from those losses. So even if you, away from those bottoms. So even if you buy around the bottom, if you're able to hold on, historically, we've gotten good gains after that. So remember that stress is worse than short-term financial volatility. It's virtually impossible for everyone to withstand the current volatility we've seen. Stress is worse than short-term financial volatility. Stress can do more damage to us than the short-term impact of changes to the value of our investments. Think positively, project happiness. I mean, like one of the things that I've taken out of this, I have 4 kids, and my wife and I have talked about the fact that our oldest is 22 and graduated college this past May, that this might be the last time that we're ever fortunate enough to have all our kids home. And it's a blessing, so we're trying to take advantage of it. We've done things like have game nights, and we've tried to do other activities with our kids that we probably wouldn't be doing if it wasn't for this. It's kind of spurred us to look for ways to take advantage of the situation. So look for some things that make you feel better and project happiness instead of being stressed and in stress and fear all the time. Another thing, avoid the talking heads and the doomsayers. When I was an oil and gas analyst, I was on CNBC and Bloomberg quite frequently. If you watch those shows, you'll notice that they get really loud when they're talking about the market going down. Why? Because they're trying to attract your attention. They get paid to make you worry, because the more people that watch, the more advertising revenue that they get. They don't really take the time to truly decide if they believe what they're saying. So if you watch too much and you worry too much, you're going to watch it even more. Like I said, watching more increases the rating. So try not to. I know I had a conversation with a client last week. We were going over our financial plan. And she said, "Phil, I've been listening to you and I haven't looked at my account. And now I'm kind of nervous because you're kind of forcing me to, because we're going into the plan and I'm going to see what the balances in some of my accounts were." And it was okay, but it was just an interesting perspective where she had been doing just what I said. Now all of a sudden I was the one that was making her look. another thing that's important to do this, I know it's hard when we're stuck in our home so much, but if you have exercise and fitness routines, maintain or improve them. Go for a walk. I know I get up every morning and get on the elliptical. There's been one day since this whole thing started that I didn't get on the elliptical, and that was the day that I felt the worst of any day. The stress was my stress level was the highest, the one day that I didn't do that. By getting up and getting my exercise in, I know that I've done that. It gives me a relaxed feeling when the day starts, and it makes it a lot easier to get through the day. So, find whether it's go for a family walk, or, sometimes you can, like on a day like today, it's not a day for a walk, but you can go and, sometimes I'll do laps in the house, walk around the house, and just do something to get yourself going, or play a game with your kids or something like that. But try to make sure that you do things to help relieve your stress. If our goal is to help and support the people we love, then we should do what we can to make that happen. We should make sure that we can be better listeners. We can offer to help our clients, our family, our friends, our colleagues, see if there's anything we can do in our local community to help. Maybe there's an older neighbor that we can help out by doing some shopping for them. We can get together with friends and family virtually. Zoom is a great tool for that. In our family, my wife wanted to talk to some of her family that's outside the U.S. even, and I was like, we never do this. Now all of a sudden we are, but we've had calls where we had like 15 people from several countries in the world on. When the holidays came, we did some of our holiday celebration through Zoom so that we could be with family. As I said up front, the market's been quite turbulent. I have a 2020 Turbulent Market Survival Guide. If you'd like a copy of that, you can send an email to me. It's philweiss@apprisewealth.com, and I'll be happy to send it to you. Just to give you some context as to how volatile the market's been. I looked at the market movement over the last several years. In 2017, we had 4 days where the market went up by more than 1%, and 4 days where it went down by more than 1%. In 2019, we had 22 days where the market went up by more than 1%, and 5 days where it was down by more than 1%. In the period since February 19th, we've had 22 days where the market's gone up 1%, 24 days where it's gone down 1%. On average, the market movement up or down is 3.4%. Our best day was a 9.4% gain, and our worst day was a 12% loss. So the markets have certainly been very turbulent, and much more than we've experienced over the last several years. Now I'm happy to take any questions that any of you may have. All right, well, it appears as if there aren't any questions. So the only other thing I'll do is I'll tell you that in addition to the Turbulent Markets Guide that I mentioned, if you're interested in that, just send me an email. I also have virtual office hours. If anybody wants to talk one-on-one, you can use the link that's shown here, and that'll give you access to my calendar, and you can schedule a free 15-minute call. There's no obligation, no cost to that at all if you're interested. All right, and like I said, if there's no questions, I'm going to wrap it up here, but I'll wait just to make sure that there's nothing else. And Karen, you can close out if you like.
Thank you, Phil, for presenting for us, and everyone for attending. If you have questions, you can, like I said, Phil put his contact information up here. Email him, or email me, and I can put you in contact with Phil.
Thanks, everybody. I appreciate your attention.
Thank you very much, Phil. Appreciate it.
Thank
Hope
you.
have a good day,
Phil,
everybody.
Yes.
one quick question. I see that you're recording this.
Yes.
Can you send it to me, and we can send it out to everyone who attended in case they want to watch?
Sure, I'll be happy to do that.
Okay, thank you.
You're welcome. All right,
Thanks, Phil.
safe and healthy. Thank you very much.
Thanks, Phil.